On February 11, 2026, the London Stock Exchange Group, or LSEG, suddenly surged into the market's spotlight. News broke that Elliott Management, a heavyweight activist investor, had quietly built a significant stake in LSEG. The market's reaction was swift. LSEG's shares jumped over 2% in a single session, not because of new earnings or products, but because of Elliott's reputation for shaking things up. For months, LSEG had been the weakest performer among major European exchanges, weighed down by doubts about its data and analytics division in the age of AI. Elliott's arrival was seen as a turning point, a sign that the company's undervaluation had finally attracted a player known for unlocking value. The rally underscored a key market truth: perception can be as powerful as performance. The company's fundamentals hadn't changed overnight, but the narrative had. With Elliott on board, investors anticipated greater scrutiny of LSEG's management and strategy. The mere expectation of action, not action itself, began to repair the stock's battered reputation. This episode is a reminder. External forces and market psychology can dramatically shift a company's valuation. Elliott's presence put a floor under LSEG's stock, signaling that change and opportunity might be on the horizon. To understand the market's excitement, you need to know what activist investors like Elliott do. They don't just buy and hold, they buy big, then push for change, aiming to unlock hidden value and boost the stock price. Their tactics range from private talks to public campaigns, often targeting strategy, governance, or underperforming assets. In LSEG's case, speculation swirled. Would Elliott push for a sharper AI strategy, or demand better communication with investors? Activists force management to confront tough questions and justify their plans, accelerating changes that might otherwise take years. While their presence can sometimes lead to short-term thinking, the initial market reaction is usually positive. For LSEG, Elliott's involvement was seen as a constructive force, an agent of accountability and potential transformation. The market's cheer was a bet that Elliott would help LSEG adapt and thrive. LSEG is far more than a stock exchange. It's a global data and analytics powerhouse, thanks to acquisitions like Refinitiv. Its data division is the engine, providing essential information and tools to financial professionals worldwide. This business, built on subscriptions and licensing, offers stable, recurring revenue. LSEG's data is the financial world's central nervous system, deeply embedded in client workflows, creating a powerful moat. But this very strength became a source of anxiety. Could AI disrupt the need for LSEG's proprietary data? The fear is that AI could democratize access to financial information, eroding LSEG's premium. This threat to its most profitable segment set the stage for the stock's decline in late 2025 and early 2026. Understanding this business model is key to grasping the market's recent concerns. In late 2025, a new fear swept LSEG investors, not economic or political, but technological artificial intelligence. Breakthroughs like Anthropic's Claude Opus 4.6 and advanced AI plugins showed that machines could analyze financial data at scale, threatening LSEG's core business. Investors worried that AI could bypass LSEG's platforms, letting analysts access and process public data directly. The result: a sector-wide sell-off, with LSEG as the poster child for AI-driven anxiety. The fear was simple: if AI could do the job, why pay for LSEG's services? LSEG's stock tumbled to 3-year lows, as the market priced in a future where its competitive edge was eroded. The sentiment turned sharply negative, regardless of LSEG's reassurances. The market's reaction to the AI threat was swift and severe. LSEG's stock endured relentless selling, lagging far behind its European peers. Years of gains were wiped out, with the stock hitting levels not seen since early 2023. Strikingly, this happened even though LSEG's financial performance remained solid. Earnings estimates barely budged. The disconnect was clear. fundamentals were stable, but fear of future disruption drove the price down. Every new AI announcement fueled the bearish narrative, creating a negative feedback loop. Investors focused almost solely on the risk to the data division, ignoring the company's strengths. The panic untethered LSEG's price from reality, as the market decided AI posed an existential threat. This extreme pessimism made LSEG a prime target for an activist like Elliott, who saw a fundamentally sound company punished by fear. Elliott's entry signaled a chance to reevaluate and unlock value. Amid the panic, some analysts took a closer look at the numbers. Barclays argued that the market's reaction was overblown, driven by sentiment rather than facts. Their analysis showed that only about 5% of LSEG's total revenue was truly at risk from AI disruption, not the entire data division. This manageable risk contrasted sharply with the market's assumption of a looming existential crisis. LSEG's earnings forecasts remained stable, highlighting a crisis of confidence, not performance. The market had painted LSEG with too broad a brush, ignoring the details. Barclays' report was a reminder. In investing, details matter. The real risk was specific and limited, not company-wide. The sell-off was more about fear than fundamentals. Comparing LSEG to its European peers reveals why it became the focus of AI fears. LSEG gets about 55% of its revenue from data and analytics, far more than Deutsche Börse or Euronext. For Deutsche Börse, data is just 12% of revenue. For Euronext, about 16%. So, while AI poses some risk to all, LSEG's exposure is much greater. This made LSEG the obvious target for investors worried about AI disruption. Yet, Barclays estimated the actual AI risk for all these firms was in the low single digits. LSEG's strategic focus on data, once a strength, became a liability in the eyes of the market. The episode shows how business concentration can amplify vulnerability to new threats. Despite the market's fears, LSEG hasn't been passive. It's been proactive in embracing AI. Management sees AI as an opportunity, not just a threat, and has forged partnerships with leading tech firms. LSEG has secured data licensing deals with Microsoft, Anthropic, OpenAI, and others, ensuring AI tools must pay for access to its premium data. This turns LSEG into a toll booth for the AI information highway, creating new revenue streams. Clean, reliable data is LSEG's edge. AI models need it to be effective. LSEG is also co-developing products, like its 10-year partnership with Microsoft, to build next-gen analytics solutions. By embedding its services in major tech ecosystems, LSEG is working to stay indispensable. This proactive stance was largely ignored during the panic-driven sell-off. LSEG's strategy is to turn disruption into opportunity, not just defend against it. The company is positioning itself at the heart of the AI revolution. LSEG's stock volatility is a lesson in market psychology and the power of narrative. The fear that AI will destroy LSEG drove a dramatic, arguably excessive sell-off. The market often runs on emotion and headlines, not just logic. The real risk was a manageable 5% of revenue, and LSEG was already adapting. Elliott's arrival forced a re-examination. If a savvy investor saw value, maybe the panic was overdone. The episode highlights the need for independent thinking and due diligence. The best opportunities often arise where perception and reality diverge. Sentiment can shift quickly, detaching price from value. Digging into details and understanding both risks and opportunities is crucial. If this changed how you think about markets, subscribe for more practical finance lessons.